Hello everyone, Monty here, head of market research at capital.com. Those daily market reports you've been receiving, it's about time you got to know them a little bit better. Bit of housekeeping we're going to get out of the way. Releases at 9 a.m. Dubai time, well before the European Open, so you can go ahead and plug and chug and place your trades in for the European session as well as the US. 6 languages with more on the way. 28 markets, you heard that right, 28 markets from 5 asset classes covering the most popular markets here at capital.com. Indices, commodities, FX, crypto, big tech, you name it, we've got it. What does it look like? Well, there you have it. That's the front page. And in fact, once you've downloaded it, if you just click on the tab, it'll take you directly to your page, so you don't have to scroll through 30 different pages. This is an example for gold today. And if you want to go back to the home page, you don't have to scroll all the way back up. You just click in the top right corner. So that's out of the way. Let's go ahead and get started. And we're going to start with those sentiment circles on the right. Let's start with client sentiment. This is capital.com's very own client sentiment. It goes without saying, blues for percentage of traders long, red for those that are percentage short. Now you're going, hang on a second, I see 2 sentiment circles, and you're right, that's because the outer circle is where they stand as of today morning, whereas the inner circle is as of the previous trading day. That way you can see how they've changed from one day to another. If you're seeing this on a Monday, for example, the previous trading day is going to be a Friday for gold, but if it's a cryptocurrency like Bitcoin or Ether, then the previous trading day will be Sunday, because we do capture price as well as sentiment over the weekend. It's important to know where other players are, how they react, and where they've positioned themselves. Of course, they've got a large, or I should say more patience for holding losses, but they don't necessarily have deep pockets, so they are going to be more prone to stop outs. In contrast with institutional sentiment. Now, this is based on the CFTC's latest report, releases Friday night, and it's updated here on Monday morning in Capital.com's daily market report. Now, the original raw numbers show lot sizes. I've converted them from positions to percentages for your use. Outer circle is of most recent Friday release. The inner circle is from the Friday before, so we're looking at it week on week. They tend to position for the longer term, have much deeper pockets to weather the storm. This is the speculative side of the COT report, not the commercial. And something you want to note is that they might be trading a spread or portfolio diversification or even hedging, especially when it comes to key US equity indices or even the FX majors. And on some of those markets, by the way, speaking of indices and FX, they also have a breakdown for leveraged funds and asset managers, because those figures are available on the COT report. But we're not quite done yet when it comes to sentiment, and that's because this daily chart that you see in the middle of the report, well, sentiment is mapped onto it. That way you can see where traders were in the past using the left axis for percent long. So the right axis is price, left axis is percent long, and that's based on the dotted line. So green dotted line is for institutional sentiment, yellow dotted line is for client sentiment, and where applicable, where you see the purple dotted line, that's for leveraged funds. The 50-50 black line, that means whenever you see the dotted line above, it means they're majority buy. Whenever you see the dotted line below, it means that they're majority short. That way you can see where exactly they may have shifted from majority short to majority buy, and so on and so forth. So that's when it comes to the sentiment and mapping it onto the chart. Now let's get a little bit technical and start with those technical boxes. The first one, MA short. MA stands for moving average. It's price compared to short-term moving averages. It's usually used for intraday trading, and it's either going to be bullish, bearish, or neutral, depending on where price is with respect to those short-term moving averages. MA long, or price compared to long-term moving averages, usually meant for intraday trading. If you're looking to place 1 or 2 trades per week, and also it's either going to be bullish, bearish, or neutral. DMI stands for directional movement index, and it's used with ADX to determine trend strength and direction. It's either positive, negative, or neutral. Speaking of ADX, average directional index, it's used to determine the trend strength, not direction. So it's not going to say up or down, rather whether it has a propensity to trend or it's consolidatory. RSI is a popular one. I'm sure most of you have heard of it. Relative Strength Index. It's a momentum-based indicator that uses speed and change of direction. It's either an oversold, overbought, or neutral. Last but certainly not least, price with respect to the Bollinger Bands. It's either at the upper extreme, lower extreme, or in the middle. And these technical boxes, by the way, are used in conjunction with other key items to determine the technical overview, which brings us to the last segment, the technical overview, strategies, and levels. Now there you'll see 2 columns here, one for daily and one for weekly. Daily overview or daily time frame, you'll have daily technical overview, daily strategies, and daily levels, and this is updated daily. So every time the market report releases, you'll see that either when required, the overview will be updated alongside with the strategies and the levels, because let's face it, prices are always changing. The weekly is for the weekly time frame and has weekly overview, strategies, and levels, and it's updated every Monday. Now this is going to be relatively static, not because it's updated only once a week, but because of the weekly time frame, it takes a long time for a technical shift or something significant to happen on the weekly time frame, and it also incorporates a lot more historic pricing data. The technical overview, whether for the daily time frame or the weekly time frame, and they don't have to be the same, by the way. In fact, a lot of times they're different, and they can even for a brief period of time be opposite. If you see a significant bull run, the weekly time frame could be a bull trend or bull average, whereas if there's a short-term pullback, it might be enough to actually tilt the daily time frame's technical boxes and indicators to something negative, to show, for example, consolidation with negative bias, or even briefly go for an initializing bear trend. But the thing about technical overview is that it doesn't predict the future. It's a snapshot of the technical overview at any given point in time, a bit like business sentiment or real estate. If you're going into a market and you just ask, where have prices been going? They've been going up. Does that mean it's going to keep going up? No, but it does tell you right now what's been happening as of late. And it can easily shift, by the way, due to fundamental factors like central bank decisions when it comes to the FX majors, risk appetite for safe haven products like Japanese yen or Swiss franc, commodity market for commodity currencies like the Canadian dollar, Australian dollar, New Zealand dollar. Therefore, eventually it's going to shift. It's a matter of how you want to trade it until it does shift. And it's here, strategies. Either they're going to be in line with its current technical state, or you'll be going against its technical state for contrarian traders. So either conformist or contrarian. And there are three main ways to trade. I mean, the strategies are going to be set there, but three main ways in which you can trade a level. When price approaches it, you can either go for a breakout, so you're going with the move if momentum is picking up and the trend is strong, or you see an uptick in volatility. A reversal strategy, if volatility is high but a retracement is likely back in the direction of the trend, so you wait for the level to break, and then as it's coming back down, you initiate. You don't initiate right away because you're worried about getting stopped out. Whereas fading, where you make a move at before its price, you're pouncing on an opportunity early on instead of waiting for a reversal that may never occur. So three main ways to trade a level. What exactly are these levels when you see first resistance and so on? A relative starting point roughly coincides with the open, and then come the first levels, first resistance and first support, which are seen as the first line of defense. Second levels get breached in times of excess volatility or significant fundamental news, but really on the daily time frame. It's rare for it to reach the weekly time frame unless you've got real significant volatility in a market that is known to experience high levels of volatility. For example, cryptocurrencies, or when it comes to earnings for some of the single stocks that are out there. So when the earnings releases is such a big move, you could have 6, 7, or 8%, and that could easily break or go beyond even weekly second levels. Those gray boxes with black font, those are stop losses, are set to limit losses, because profit taking at the end of the day is going to depend on the client's reward appetite. Well, there you have it. All the key segments explained when it comes to the daily market reports. If you do feel like you need to know a little bit more very briefly, you could just click on the guide. It will show you that. But otherwise, I want to thank you guys so much for watching. Good luck out there.